When investors qualify truly elite businesses, the first businesses rattled off are the tech giants: Microsoft, Google, Apple, Nvidia, the Magnificent Seven. The media loves them, super investors love them, retail investors love them, and for good reason. These businesses are pushing the world to the AI future. Manifestos are written by investing influencers and brokerage houses to justify their high PE ratios, extolling their aggressive growth and disciplined cost management, and again, for good reason. These businesses are exemplars of how an elite business should be run. But there is one business that mystifies the investment community. Its 10-year annual return is nearly double the S&P 500, and its one-year return is 59%, a sky-high PE ratio with a razor-thin margin. And like clockwork, they posted another solid quarter of growth. Today, we are looking at Costco. Welcome to the Quality Investor. The standard refrain for Costco, ticker COST, is, "Oh, they'll revert to the mean soon." Or, "No way is a 53 PE ratio justified for a business that sells groceries and household goods." And it's true. None of it makes sense. They barely grew their revenue 8% annually over the last 10 years. Their gross margin is essentially capped at 14%. Their operating margin only scrapes 3.4% on occasion. I discuss the importance of investing in capital-light businesses. The reason is when a business has a low reinvestment rate, that means more money left over for owners or investors. A business that needs to reinvest 10% of its earnings to grow at 10% is fundamentally going to generate a higher return than a business that needs to reinvest 50% of its earnings to grow at 10%. See my ROIC video linked below. Well, Costco is one of those businesses that has a 50% reinvestment rate, and they don't even grow their revenue at 10%. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. But today, I want to look at their Q4 fiscal year 2024 earnings and discuss their valuation. It was a solid, but not great, quarter for Costco. They grew in some areas, but lagged in others. Despite this, they've only fallen a modest 2% since earnings. The market shrugged off their so-so report. Yet, the investment community is miffed at their 50-plus PE ratio and clamoring for a pullback. But Costco's share price is like the tortoise in the infamous race, slow and steady, always winning in the end. So, I'll give you what my investment thesis is for Costco, which I believe explains a large part of their PE ratio, and then we'll dive into the earnings and valuation. I've done in-depth Costco videos before, which are linked below, but a summary of my investment thesis is as follows. Costco's business model is simple, yet astoundingly effective. The membership model, in exchange for access to high-quality, low-cost goods, drives huge volume. The design of their warehouse stores plays on human psychology to drive purchases. Costco has the best-in-class inventory management system. It has the highest inventory turnover in non-grocery retail, and its relatively low number of SKUs allows the procurement team to focus on high-quality merchandise for customers. The economic moat is incredible. Aside from the best prices in the industry, they have an almost cultishly loyal customer base, have turned shopping into an adventure, and have an obsession with customer satisfaction that few competitors can match. Their growth strategy is ambitious. They plan on adding 25 stores per year through 2028, and then 30 stores per year from 2029 to 2033. In 2024, they opened 30 stores, which was well ahead of their 25 store budget for 2024. The first thing I want to point out here is the comparable sales growth. In retail, comparable sales is an important metric. It measures revenue growth for all the stores that already exist for the retailer. So it's excluding any new stores that were built throughout the year. So you're seeing the impact on just existing operations. And we can see here for the fourth quarter, it was at 5.4%. The 6.9% here is excluding gasoline and foreign exchange fluctuations, but I like looking at the actual impact. So 5.4% comparable stores growth. On the year, it was at 5.3%. And what we did see was a slowdown in the US, 4.5% on the year. It picked up a little bit in the fourth quarter, but they're definitely growing more internationally. Overall, that 5.3% comp sales is up from last year in 2023, but it's still down overall from the 2022 and 2021 numbers, which are each above 10%. So we're still seeing a little bit slower growth out of Costco, and I think that might be the story going forward. A slowdown in growth in general. They are becoming a very large business after all. The real growth will come internationally. Looking at their income statement here, we can see that they had $254.453 billion in total revenue for 2024. That is a 5% increase over 2023. So a very modest increase for Costco as a whole. One bright spot, though, is we can see that they generated $9.285 billion in operating income, up from $8.14 billion. But more importantly, it was a 3.6% operating margin for 2024. That may seem tiny, however, that's up 30 basis points year over year. The reason for this is actually kind of interesting, could be another potential growth factor for Costco. On the earnings call, the CEO mentioned the main driver for that operating margin increase was their e-commerce business. And we'll see a little bit more about that in a second. And finally, on the income statement, they had $16.56 of diluted earnings per share, up from $14.16 earnings per share last year. That's actually a 16.9% year over year increase. And that increase is actually more impressive when you consider Costco doesn't really do share buybacks. You can actually see their shares outstanding actually increased year over year. So they're creating real value for shareholders here without the veneer of share buybacks, which don't actually add value to a business. On their cash flow statement, we can see that their free cash flow, which you take the operating cash here, the 11.3 less the additions to property and equipment, the 4.7 billion here, that was actually down 1.7% from the prior year. Total free cash flow for 2024 was at 6.629 billion, down from 6.745 billion a year ago. And to me, the main reason for this is really that slowdown in sales. We saw that slowdown in comparable sales activity. The slower growth has led to a bit of stagnation in that cash flow. And that's something we really do need to see out of our businesses that we invest in. We want to see growing free cash flow every single year. That's the sign of a business adding value to shareholders. Now, I don't have any doubt Costco is going to continue to do that in the future, but I wanted to point it out just because you can really see the effect slowing down of sales can have on a business. Couple that with that 50 plus PE ratio, and you can see why some investors, some in the investment community, are a little bit surprised that Costco continues to trade at what it does. Overall, their cash fell by $3.794 billion on the year. And really, this is due to the fact that in Q1 of their fiscal year 2024, they paid a special dividend out. And that's why you can see that massive dividend payment here of $9 billion versus the $1.251 dividend payment in the prior year. But really what this demonstrates is they're going to pay this special dividend periodically because while their cash flow is down a little bit, they generate so much excess cash, they can't reinvest it all. See here, that 4.7 billion in property and equipment. They can't reinvest all of that fast enough to achieve a sustainable type of growth. So while their sales may have slowed a bit and made that cash flow drop by a little bit over 1% in 2024, they're still an extremely cash-rich business. And I think that's part of the reason why investors are paying that over 50 PE. So here's that e-commerce business I was talking about. Now this is the Q4 highlights. They increased their Q4 by 18.9% over the prior Q4. For the year, they increased their e-commerce business by 16.1%. So you can see they actually accelerated that growth in Q4. And all the metrics Costco's using here have seen some nice growth. New mobile application downloads at 29%. Site traffic's up 8%. The average order value's up 5%. Costco's logistics department up 17%. And just anecdotally, I did a video a couple weeks ago on Vici, the Las Vegas REIT. That trip I booked to Las Vegas, I booked through Costco Travel on their website. So this is an interesting growth market here for Costco, and I think something to kind of watch out for going forward. It's growing much faster than the bricks and mortar part of the business, which makes sense, but this could provide some real operating leverage for Costco that they don't normally have in their typical retail business. So something to keep an eye on, and we'll see going forward each quarter if they can keep it in that 15 to 20% range of growth each quarter. So I've alluded to Costco's PE now quite a bit. So let's take a look at some numbers here and see if it really is worth buying in at that 50 plus PE. This is my revenue model for Costco. And you can see from 23 to 24, that store count increased from 861 to 891. It's a 3.48% increase. Costco's Q4 report, they said their total paid member count at the end of Q4 was 76.2 million. That's a 7.3% increase from the prior year at 71 million. So that comes to about 85,522 members per store, which is a 3.71% increase year over year. Their total membership revenue for the year is at $4.8 billion. So that can give us fees per member at $63.36. Now, if we look at that, that's actually a 1.78% decrease from the prior year. Now, Costco did increase its membership fees late in their fiscal year 2024, so we're not going to see that impact until 2025. So what this might suggest is that new members are actually opting for the lower tier membership, the standard plan, instead of the executive plan that Costco offers. At the old rate, I believe the standard was at $60 per year and the executive was $120 per year. The point is, more people are probably opting for that lower tier program. The other thing that you notice here is that the merchandise sales per member also decreased 2% year over year. It's about $3,276 per member on the year. And I got that basically from the merchandise revenue divided by the paid member count. So people that are members are also buying less than what they normally do at Costco. There may be a myriad of reasons for this. Many will probably cite this looming recession that we're supposed to have. But whatever the reason, the fact of the matter is people spent less in 2024 at Costco. So ultimately revenue was up in 2024 by 5%, mostly due to the fact they did increase membership by 7%, as well as the addition of 30 new stores. So projecting out the next 10 years, I just want to show you what my compound annual growth rate I have. Total revenue growth of 9% over the next 10 years. I have the store count increasing by just over 2.5% per year. Membership increasing at 2.5% per year. Membership per store increasing at 2.5% per year. Total membership increasing at 5% per year. The fees going up at about 1.2% per year. Mostly this is just due to new members, not necessarily an increase in fees. Merchandise sales per member going up at a 3.7% per year. And merchandise sales per store going up at 6.3% per year over the next 10 years. Ultimately, summing the paid member count increase plus the fees per member gets you to about that 6.4% membership revenue increase, and paid member count plus your merchandise sales per member gets you pretty close to that 9% total merchandise revenue increase. And these growth projections come mostly from Costco's own store projected count, as well as what analysts are projecting in terms of membership. So looking at growth rates to get us to our free cash flow growth, which is what we really care about at the end of the day as investors, I'm projecting a year 10 operating margin of 3.75%, net margin at 2.8%, and the same thing for free cash flow margin at 2.8% by year 10. We already saw that 9% annual compound growth rate for revenue. Operating income should grow about 9.3% per year, net income at about 8.7% per year, earnings per share at 9.26% per year, and ultimately free cash flow at 9.87% per year. All in all, very modest growth over the next 10 years for a business that has done pretty well in the previous 10 years at 12.78% free cash flow growth. As we can see here, that gives us a discounted cash flow price, at least in the base case, of $536.84. That's a far cry from their current share price of $883.11. Looking at the dividend discount model, things are a little bit different for Costco. In fact, Costco pays an excellent dividend. Despite a paltry 0.5% dividend yield, Costco could be considered an excellent dividend growth stock. They currently have a free cash flow payout ratio of 29.3%. They've also increased their dividend now for 21 consecutive years, so they're on the cusp of dividend aristocrat status. Over the last 10 years, they've increased that dividend by 12.6% per year, and it's been very stable growth of that dividend throughout. You can see here no major swings up or down in the year-over-year growth of their dividend. And from a dividend perspective, that's what makes them actually a very attractive dividend growth stock. There's a lot of room to grow for that dividend. And I mentioned before how they have so much excess cash, they reward investors periodically with those special dividends. But due to Costco's very healthy free cash flow payout ratio and a very healthy growth rate at 12% per year, projected over the next 5 years, I'm very confident at a 7.5% perpetual dividend percent growth rate. That gives us a dividend discount model price of $1,000.73. That's way above their current trading price at $883.11. So the real power of Costco lies in their dividend and their ability to reward shareholders. So like I said, they're trading at $883.11 currently, which is a 53.3 PE ratio. And in fact, based on my projection for year one for the earnings per share, I have them at a 54.2 PE ratio and a forward PE. That is way above their 5 and 10 year average, both PE and forward PE. On a DCF basis, their bear price is at $420.83. And just for reference, I have them growing about 7% revenue per year there. Base case, as we saw, was $536.84, and a bull case, $676.81. And that's at about 10.8% revenue growth over the next 10 years. But like I mentioned, the dividend is their power. On the bear case, it's $832.69. This projects 11% dividend growth and a 7.375% dividend perpetual growth rate. Base was at $1,073.43 and a bull case dividend of $1,475.82. And this is a 13% dividend growth rate with a perpetual growth of 7.625%. Ultimately, still doesn't look very good for Costco. Their valuation averaged at $564.98, $724.64 on the base, and $956.46 on the bull case. Really not a lot of upside here, no matter where you're looking. Even on the bull case, it gives us 8.3% upside. With absolutely no margin of safety, this is $742.68 buy price and a forward PE of 45.6. So even without a margin of safety, given the current free cash flow and the current growth projections of that free cash flow, Costco's share price would have to come down about 16% to even become in the reasonable category. And with a 10% margin of safety, it would have to come down to $668.41. That would amount to a 24% drop in share price. Now, in a recession or some sort of market shock event, that's certainly possible. Costco has done that before where they've come down drastically in share price. Many people agree that they're way overvalued at a 53 PE. Now, personally, I would not buy in at the prices that Costco's at today, despite the fact I think it's one of the safest businesses in the world. But I can also see how that 53 PE is justified just due to how strong their economic moat really is and how strong of a future of dividend growth as well as international growth Costco actually has. But on the quality investor, we will only buy in to a quality business if it's at a reasonable price. And I think right now at $883, Costco is not at a reasonable price. I would love to see it dip below 700 before I consider adding more to my portfolio. It is still one of my best performing stocks in the portfolio, but I need a compelling price to add more right now. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.